General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Okay, let's do the chart work. Today's Friday, the 28th. Monday ended up being an anchor. No expansion today. Terminus was hit today on the upside. March 1st Jackson Hole's speech pushed back hard against the idea that inflation has already been beaten. He said that if the Fed isn't confident underlying inflation is moving towards 2% with enough speed, it has quote-unquote work to do. He also said financial conditions don't appear particularly restrictive. The market heard it as a rate hike is legitimately back on the table. September hike odds jumped roughly from 35% before the speech to 57 and 60% afterwards. Bonds gave the clear signal. This was probably the most important cross-market move for your NASDAQ analysis. 2 years jumped around 11 basis points to 4.34%, 10-year around 5 basis points to 4.72%, 30-year roughly fat around 5.20%. So the biggest selling happened at the front of the curve, which makes sense because the 2 years the most sensitive to Fed policy. That's basically the bond market saying we need to price move Fed tightening from the Fed. That is naturally a headwind for duration-sensitive NASDAQ/tech. NASDAQ weakness was real, not just the index. NVIDIA gave back part of yesterday's huge post-earnings move. NVIDIA was down 4.6%. Marvell fell 10.3%, but some mega caps held up. Google was up 1.7%. Apple up 1.6%. Salesforce up 1.6%. Breadth was pretty weak too on NASDAQ only. 1,400 stocks advanced versus 3,200 declining. More than 2 losses for every winner. So I wouldn't dismiss today's NASDAQ decline as only NVIDIA profit taking. Dollar up, gold crushed. The dollar reacted exactly how you expect to a hawkish Fed repricing. Dixie up 0.59% to 99.69, its biggest daily gain in roughly 2.5 months. And gold got smoked. Spot gold around down 2.9% to 4,500, and December gold futures around the same. Silver down 3.5%. That actually gives you a very clean macro chain for today. Wash was hawkish. Hike odds went up. 2-year went up. Dollar went up. Gold went down. And that's pressure on NASDAQ. Consumer data was mixed. Final mission consumer sentiment came in at 51.7. Slightly better than expectations around 51, but still down sharply from 55 in July. The The interesting part was inflation expectations. 1 year 4% down from 4.2%. The long run 3.3% is unchanged. Consumers are still worried about inflation and purchasing power, even though near-term inflation expectations ease slightly. Oil wasn't the problem today. WTI finished around 83.40, down 0.16%, while Brent fell 0.43% to 89.39. Both were down substantially for the week. The market is hearing rumors and progress around potentially restoring more normal shipping through the Strait of Hormuz, which is reducing some of the geopolitical premium in crude. Okay, so Jackson Hole was kind of lame. Monday, Tuesday in the range. Wednesday, Nvidia, but still in that range. Overnight gap up, chop for the day, wash talks. But overall, we didn't go nowhere. We didn't hit my fair value for buying. This was a nice reaction at the volume and balance throw. Uneventful Friday, Jackson Hole did a good job of holding the market. Get the H1. Kind of choppy day, not really too much going on. Took the high but didn't take the low. Chopping to a news event, then seek and destroy profile. Here's the M15. Yeah, it's not really exciting. The Zoom motor delivering a chop. Go gold. Nice sell off from this doji. I've been watching that white oak dude. He be using these dojis as zones. But we did hit this internal range liquidity right here, so that's pretty good. Price finally made it to the internal range liquidity sweep. Before Jackson Hole, we were stuck in a range. Take a look at the H1. Yeah, it was a pretty lame week. But RCT was giving that hint. On Wednesday, he was like, he down for the week. And that was the Tuesday video, which was smart because we just chopped. And I took that hint from him, just chilled out the rest of the week. That was a smart move. So we chopped all week until the event. Here, it's readable and tradable, sweep the equal highs. So the concept's still showing up. A fallback through the daily 200 SMA is a good area to reaccumulate longs. Go Nvidia. Definitely profit taking. But like the overview said, the overall whole market was kind of super weak. Not just Nvidia. Marvell fell 10% too, so Labor Day normal price action should return. Did the framework play out? Yes. What did we learn? Even in chop on CT, concepts still give clarity to participate in price runs. And tomorrow's just a study day. All right, that's that on that. Y'all have a good day. Peace.